So your question presupposes that there is a competition as to who's going to go first, and it is looking at as if there's a race for infrastructure upgrade between Asia and Europe. I don't think that's the case. If certain markets are doing T+1 the way they are doing it, it's because there's an imminent need for it, right? There's an imminent need for it, and I don't think it is to react to what's happening as a trend. There are definite benefits of why a few of them have gone for market infrastructure upgrades or settlement compression or anything which is enhancing the efficiency of the capital markets. So you do it because there's a need and there's a driver to doing it, not because you need to do it because it's a race and you just want to win the race. That's, I think, what Asia has been trying to do, although there's a bit of, is there a war of who's going to go T+1 first or not? So that said, I think we also have a little bit of an advantage where we are much younger as a market compared to some of the developed markets. So there is an ability to transform, because if you've been doing something which is there for decades, it's a systemically very large infrastructure. Changing that is also going to be very difficult, right? So we have a chance. We are slightly more smaller and some nimbler. So therefore, there is an ability to transform things much faster. But the second part of your question, which is on, is that capital controls and FX controls? I don't think so. I don't think those are impeding the region. In fact, on the contrary, that is done to protect investor interest. I mean, if you recollect 1997 crisis that happened, it massively impacted a lot of Asian economies. Of course, the most obvious one is Indonesia, which everybody is familiar with. But what did one learn from that? One learned that, if you're having a very open economy where it just opens the floodgates, markets could crash and has massive damage to the investment fraternity, both domestic and international. So these controls were put more like circuit breakers in a way to help the larger investment base. It is not to try and do other protectionist measures and other things. So you have to look at it from a different perspective. Then it won't really matter. The other point in favor of that is, notwithstanding these kind of capital controls that some countries have, not all of them, it has not stopped foreign investors flow. On the contrary, there have been increased flows, but that has always been driven by the valuation, the attractiveness of the market, not so much driven by this. But one other point, an important point to note is, beyond these controls, how the regulators react to a situation to help the investment fraternity is an important one. And there have been many instances across countries like India, how during a challenging situation, the regulators have come to stem and control the market to protect the investor interest base. That gives them a lot of confidence.